Ever wondered how individuals and corporations manage to swindle billions from unsuspecting investors? From the infamous Ponzi schemes to elaborate corporate frauds, the world of finance has seen its fair share of shocking scams. Today, we delve into the murky waters of financial deceit to uncover the stories behind the 10 biggest scams in history. These tales reveal the lengths people will go to for money, the devastating consequences for investors, and the enduring lessons in financial vigilance. Join us as we unravel these jaw-dropping accounts of greed and deception. So, without any further delay, let's begin. Number 10. Charles Ponzi. Charles Ponzi gained infamy in 1919 for orchestrating one of the most infamous financial schemes in history. Promising investors hefty returns from arbitraging international reply coupons, IRCs, Ponzi purportedly exploited price discrepancies between countries. Initially successful, he used new investments to pay returns to early investors, fueling rapid growth. However, Ponzi's scheme unraveled when he couldn't sustain payouts. By 1920, he was exposed, leaving countless investors penniless. Ponzi's name became synonymous with fraudulent investment schemes, illustrating the enduring lesson that promises of unrealistic returns often conceal unsustainable and deceitful practices, impacting the lives and savings of unsuspecting individuals. Number 9. FTX. Until November 2022, Sam Bankman-Fried was hailed as a leader of the blockchain revolution. He made his fortune trading cryptocurrencies and founded FTX, the second-largest crypto exchange in the world. However, the money from investors and shareholders was placed in risky investments, and the company overstated $8 billion in profits and assets. Some argue this was not a classic Ponzi scheme, but rather fraud or embezzlement. Regardless, fraud is fraud, and the collapse of FTX left investors reeling. The rapid downfall of FTX and its founder's fall from grace is a stark reminder of the volatility and risks inherent in the cryptocurrency market. Number 8. BitConnect. BitConnect captivated investors with the promise of daily returns through a purported cryptocurrency trading bot. Its aggressive marketing strategy, including viral videos and charismatic promoters, attracted a vast network of affiliates who recruited new participants. The scheme offered unrealistic returns, promising financial freedom and easy wealth. However, in 2018, BitConnect's facade crumbled dramatically. The value of its token plummeted from $331 to $21 in just hours, erasing billions in market capitalization. Investors faced devastating losses, and legal actions ensued against its founders. BitConnect's collapse stands as a stark reminder of the dangers inherent in unregulated investments and the importance of thorough due diligence before committing funds. Number 7. Enron. Enron's collapse was one of the most devastating corporate scandals in history, costing investors $74 billion. The company's unprecedented growth led to a stock price high of $90.56, attracting massive investments. However, in 2000 to 2001, the truth was revealed. CEO Jeff Skilling, former CEO Ken Lay, and CFO Andrew Fastow had been cooking the books, reporting false growth. When the company went under, thousands lost their savings, and the CEOs received only 6 and 12 years in prison. Enron's downfall led to significant changes in regulations and corporate governance practices, aiming to prevent such a catastrophic failure from happening again. Number 6. WorldCom. During the 1990s, WorldCom soared to prominence as one of the largest telecommunications companies globally, driven by aggressive acquisitions and market expansion. However, as competition intensified and demand for telecom services plateaued, WorldCom faced mounting pressure to sustain its stock price. To conceal its dwindling profitability, WorldCom executives resorted to fraudulent accounting practices, inflating revenues by $7 billion through misclassification of expenses as capital investments. When the truth surfaced in 2002, WorldCom declared bankruptcy, resulting in a loss of $180 billion for investors and leaving thousands unemployed. The scandal exposed significant failures in corporate governance and auditing, prompting reforms to enhance transparency and accountability in corporate America. Number 5. Tom Petters. Tom Petters orchestrated a sophisticated Ponzi scheme that defrauded investors of $3.7 billion. Operating under the guise of a legitimate wholesale merchandise business, Petters attracted investments from hedge funds, religious organizations, and individual investors. He promised substantial returns by purchasing and reselling electronics and other goods, but in reality, he used new investments to pay returns to earlier investors. Petters' scheme unraveled in 2008 when his business empire collapsed under scrutiny. He was sentenced to 50 years in prison for conspiracy, fraud, and money laundering, serving as a cautionary tale about the risks of investment fraud and the importance of thorough due diligence. Number 4. Caritas. Caritas, a Romanian investment firm, enticed over 400,000 investors with promises of extraordinary returns, claiming it could multiply investments eightfold within 6 months. The scheme captivated the public during the early 1990s, as many Romanians eagerly invested their savings. However, Caritas operated as a classic Ponzi scheme, using funds from new investors to pay returns to existing ones. When the scheme collapsed in 1994, investors lost approximately $1.257 billion collectively. Ion Stoica, the founder and CEO, was initially sentenced to 7 years in prison, later reduced to 1.5 years, highlighting the devastating impact of fraudulent schemes on unsuspecting investors. Number 3. Stanford Financial Group. Over 2 decades, R. Allen Stanford Financial Group duped 30,000 investors across 100 countries into investing $7 billion. Promising secure investments in certificates of deposit, Stanford instead diverted funds to his personal use, including luxury real estate and lavish lifestyles. His operation relied on falsified financial statements and deceptive marketing tactics, including sponsoring cricket tournaments to project legitimacy. The scheme collapsed in 2009 when authorities exposed it as one of the largest Ponzi schemes in history. Stanford received a 110-year prison sentence, underscoring the severe consequences of financial fraud and the critical need for rigorous oversight in global financial markets. Number 2. MMM. MMM, founded during Russia's economic turmoil in the 1990s by Sergei Mavrodi, promised astronomical returns to investors, claiming to multiply their investments tenfold within a year. Operating as a pyramid scheme, MMM relied on new investments to pay returns to earlier investors, with Mavrodi pocketing significant sums. At its peak, MMM attracted millions of participants and amassed between $5 billion to $10 billion before collapsing in 1994. The scheme's demise led to widespread financial ruin for investors across Russia and other countries involved, highlighting the catastrophic consequences of unchecked financial fraud and deceptive investment schemes. Number 1. Bernie Madoff. Bernie Madoff orchestrated the largest Ponzi scheme in history, defrauding investors of an estimated $64 billion. Starting in the 1980s, Madoff's investment firm promised consistent, high returns by purportedly investing in blue-chip stocks and S&P 500 options. Instead, Madoff used funds from new investors to pay returns to earlier ones. This deception continued for decades, attracting wealthy individuals, charitable organizations, and institutional investors. The scheme collapsed in 2008 during the financial crisis, revealing the massive fraud. Madoff was sentenced to 150 years in prison, leaving thousands of victims devastated and underscoring the need for rigorous oversight and skepticism in the financial industry. Financial scams have wreaked havoc on countless lives, showing us the destructive power of greed and deception. These stories are stark reminders to be vigilant and question any investment opportunity that seems too good to be true. Always research thoroughly and consult trusted sources before investing. Protecting your hard-earned money requires skepticism and caution. Stay informed, stay cautious, and remember, if something sounds too perfect, it probably is. Thanks for watching. If you found this video insightful, please like, share, and subscribe for more insightful content. Let us know in the comments which scam surprised you the most. Until then, stay safe and informed.